What is an exchange-traded fund, ETF? A pooled investment security called an exchange-traded fund, ETF, functions very similarly to a mutual fund. ETFs often follow a certain sector, index, commodity, or other asset, but unlike mutual funds, they can be bought or sold on a stock exchange just like normal stocks can. Anything from the price of a single commodity to a sizable and varied group of securities can be tracked by an ETF. ETFs may even be designed to follow particular investment strategies. The SPDR S&P 500 ETF, SPY, which replicates the S&P 500 index and is still an actively traded ETF today, was the first ETF. Understanding ETFs because it is exchanged on an exchange like stocks are, an ETF is also known as an exchange-traded fund. As shares of an ETF are purchased and sold on the market throughout the trading day, the price of the shares will fluctuate. Contrary to mutual funds, which only trade once daily after the markets close and are not traded on an exchange, this is the case. In comparison to mutual funds, ETFs are typically cheaper and more liquid. Unlike stocks, which only hold one underlying asset, ETFs hold a variety of underlying assets. ETFs are frequently used for diversification because they contain a variety of assets. Thus, a variety of investments, including stocks, commodities, bonds, or a combination of investments, can be found in ETFs. An ETF may own hundreds or thousands of equities from different industries, or it may be confined to a single sector or industry. While some funds primarily concentrate on U.S. offers, others have a worldwide perspective. For instance, equities of different banks from throughout the industry would be included in banking-focused ETFs. An ETF is a marketable security, which means that its share price enables day-to-day buying and selling on exchanges as well as short sales. Except where subsequent regulations have adjusted their regulatory requirements, the majority of ETFs in the United States are organized as open-ended funds and are therefore governed by the Investment Company Act of 1940. The number of investors who can participate in open-end funds is unrestricted. Summary: a basket of assets known as an exchange-traded fund, ETF, is exchanged on a market just like a stock. Unlike mutual funds, which only trade once per day after the market closes, ETF share prices fluctuate throughout the day as the ETF is purchased and sold. ETFs can hold any kind of investment, such as stocks, commodities, or bonds. Some only offer holdings in the United States, while others do. Instead of purchasing the equities separately, ETFs have lower broker commissions and expense ratios. Thanks for watching.